Isn't it hard to figure out whether a stock is a good buy or not? I'm going to show you how to value a stock using a discounted cash flow model, and we're going to also look at the ratios of the company. Make sure to watch the whole video. There's going to be lots of pop-ups, graphs, and more information. It's going to make it more fun, and you're going to learn a lot more. So we're going to look at Office Depot. And first we need their market cap, and that's $1.2 billion. So we'll put that into the model. And that's the value of the company according to the stock market. And the stock price is $230. So now we know the shares outstanding because it's a market cap divided by stock price gives us the shares outstanding, 522 million. Next we need free cash flow. And that's the cash that's left over after operating your business and after paying capital expenditures. So we're going to take 4 years of that. And that's how you value a company. You estimate the future free cash flows, then you discount that number back to today's value, and then you get an intrinsic value of the company. You divide that by the shares outstanding and you get an intrinsic stock price. I'm putting the net income into the model. That's a profit and loss according to the income statement. And then we're going to put in the sales or revenue. And you want to make sure the numbers are fairly consistent and positive, because that's the only way to get a good value for the company. And it looks like that's the case. So let's get their capital structure, because we need to figure out the discount rate we need to apply to the future cash flows. So in 2019, they paid $89 million of interest on their debt. Let's go to the balance sheet and see how much debt they have. So current debt is debt due within 12 months, that's $822 million. And long-term debt of $517 million, that's debt due after 12 months. So they pay a hefty interest rate of 6.65% on their debt. But interest is tax deductible, so let's get their effective tax rate. So the income before tax is $146 million, and the income tax is $47 million. So after we take the taxes into account, the cost of debt is 4.5%. So in order to get the cost of equity, we need the beta. That's the volatility of the stock. And the higher the beta, the more volatile the stock is. And they have a high beta of 2.32. So the stock moves more than 2 times what the market moves. So let's get their current assets. That's on their balance sheet. And next, their current liabilities. And that's liabilities that are due within 12 months. And next to equity, that's total assets minus total liabilities, and that's the value of the company as per the balance sheet. Next, we need the earnings before interest and taxes, or the operating income, and that's $363 million. So they have 38% of debt in a capital structure, the rest is equity. So to get the weighted average cost of capital, it's a blend of cost of equity, the 20%, and the cost of debt, the 4.5%. So that's 14.2%. And that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows. We did a terminal value, which is all years past year 4. Then we discounted those numbers back to today's value. The price of the company of $1.4 billion. And when we divide that by 522 million shares, we get an intrinsic stock price of $265. It's trading at $230. So it's trading at a 13% discount, so it's a buy according to the model. So it looks like that stock has been trading at intrinsic value for at least 2 years now. Let's see what Simply Wall Street has the value of the stock. So they value Office Depot at $430, so they value the company a lot higher than I do. Everybody has their own model and their own assumptions, but a stock price is always based on supply and demand of the market. There's only a finite number of shares in the market. So if people continuously buy a stock, it keeps pushing the price higher and higher. And when people continuously sell a stock, it pushes the price lower and lower until equilibrium is met. Now let's look at their financial ratios. So they have a 12.1 PE. That's a really good PE. The average in the market is 26, and the median PE for the market is 16. Really low price to sales, 0.1. That's price to stock over sales per share. Much lower than the average and the median. They have a price to book of 0.6, which is really good. Under 1 is considered a great value. Let's just look at their book for a second. So the best value on the balance sheet is current assets, especially cash. And now, non-current assets like goodwill and intangibles aren't so valuable. We have about 1.4 billion in intangibles. That's not too high, but that does drag up the assets, which improves your price to book. So don't just take the number as it is. Look at the balance sheet and look at the assets and see what the assets are. If it's a lot of cash and a lot of receivables, you probably have a really good balance sheet. But if it's all goodwill and intangibles, it's probably a pretty weak balance sheet. Let's go back to the numbers. They have a current ratio of 1.1, that's great. It's over 1, so they can cover their current liability. They have a really low ROE of 5%. That's net income over equity. And remember, equity is total assets minus total liability. That's the value of your balance sheet. I like to see 20% or higher in a company before I invest. So they're not providing great value to their equity holders. But this is 1 year of ROE. Let's also look at interest coverage ratio. It's over 4, so that's good. They can cover their interest 4 times, the interest of 89 million. 38% debt, that's not too bad. The best way to look at ratios is to compare to its competitors. And Williams-Sonoma is a company that is in the same industry as Office Depot, and I also did a discounted cash flow model for them. Office Depot has a better PE, price to sales, and price to book. Although they have higher debt, and generally when you take on more debt, you could improve these ratios. So I really appreciate you watching the video. Leave a comment, any comment about finance, and I'll be happy to answer it. Thanks for watching.